This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
There are two paths you can go by, but in the long run, there's still time to change the road you're on. This week, we'll look at the paths for next year as described by a few leading analysts, and then we're going to look at how you can extend the patent on your blockbuster drug. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, one of the portfolio managers on the team. As we try to move on from the election, we're still pretty much just stuck on the election. Tons of conjecture and analysts gleaning policy guesses from the various appointments being made by the president-elect. So I'm going to start this week by taking a look at where things stand, and I'll use a few varied sources here to see what they think future policy decisions will mean for these markets. Because as JP Morgan said in a recent report, which I'll be pulling from later on here, quote, "The recent election is the unavoidable starting point for talking about the 2025 economic outlook. We can't avoid it. We are in the end of earnings season. We'll focus a little on that. But really, and we'll talk about how unimportant government policy maybe ultimately is, but it's not completely unimportant. I recently shared and focused on what Goldman Sachs thought that the S&P 500 was going to do over the next 10 years. You can find that a few podcast episodes back on the various archives for these shows. But this week, same people over there at Goldman published a 2025 economic outlook titled, quote, "New Policies, Similar Path," end quote. And for what it's worth, that very same team did publish a whole other piece this same week, same folks, and they were calling for the S&P 500 to bring 11% total return by the end of next year. But I'll circle back on that. First, as far as the report regarding the outlook on government policies, they kick it off with their baseline of where we are today as, quote, "Recession fears have diminished, inflation is trending back towards 2%, and the labor market has rebalanced but remains strong," end quote. And I'll pair that with the most recent weekly economics summary from Strategists, who started their outlook with, quote, "While a bit slower, U.S. real GDP growth is tracking positive in the fourth quarter. Initial jobless claims are remaining low, and credit spreads are narrow, all supporting a soft landing call," end quote. That credit spreads is an important bit, which the other pieces aren't focusing on. While total interest rates have come down a little bit, especially on the very short end, it's not just that the benchmark rates come down, it's that the spread to those rates come in. They haven't. Mortgages are still very high right now, but as those spreads come down, how much more than the 10-year, a 30-year mortgage, or even 30, you benchmark it to the 10-year, but how much more than that you have to pay for borrowing, that's what's important. But Strategists did go on later in that same report to say that while the Fed's likely still going to cut more, they think that they're going to skip a cut for the December meeting. And from what I've seen, the consensus right now is for a 50% chance of a rate cut in December. But back to the Goldman outlook, they're looking at what we're all seeing, saying that they expect net immigration in their model to be 750,000 people per year, a bit below the pre-pandemic levels. They expect tariffs on various imports to raise the overall tariff rate by 3 to 4%, and they expect the extension of the 2017 tax cuts, which were set to expire next year, and maybe possibly see some additional tax cuts. Overall, however, on these pieces, they, quote, "do not expect them to substantially alter the trajectory of the economy or monetary policy," end quote. Which, if accurate, then we'd be left with that opening statement of a soft landing continuing to be boosted by rate cuts and those ever-important spreads coming in. They, however, do go on to make an interesting point that the negative economic effects from tariffs and reduced immigration will appear earlier in the economic effects of 2025, while the boosts to the economy from tax cuts and deregulation show up later on. They have more of a delayed effect. And this may ultimately be an interesting period of quickly playing out mini cycles where we're seeing boosts already today from importers front-loading inventory from China anticipating those tariffs, which may be then followed by a slowdown from the aforementioned detractions of the tariffs and the reduced immigration, then followed by the boost. I mean, we're talking about a period of 12 to 16 months here where we might quickly cycle back and forth and back again. Simply put, in a vacuum, that may mean that we'll have some good opportunities to invest over the next 6 months, meaning prices may be indeed lower at times, but we shouldn't lose sight of the longer-term outlook. But let's look at some other opinions here. In a similar themed report by J.P. Morgan this past week, they too point out the same subjects here, calling it two paths that the nation's economy may take over the next year. And while again pointing to tailwinds from deregulation and tax cuts and headwinds from tariffs and also just general policy uncertainty, they then make the solid point that, quote, we shouldn't lose sight of the business cycle which has been performing well, end quote. We are all expelling a ton of energy and time talking about and thinking about government policy, when ultimately it only has so much effect on the ultimate revenue and the earnings and the outcomes of the businesses that we own or consider for our portfolios here. But while J.P. Morgan agrees with this in their report, saying essentially that while it's not that the policy doesn't matter, but it's not the only thing that matters, more importantly, they conclude that the business cycle and the conditions affecting that are what leads to results and, quote, as of late 2024, that business cycle has been evolving in a favorable manner, end quote. Things are improving heading into next year right now. Morgan does go on to predict that the Fed is going to cut interest rates in December, so they'd be on the yes side of that 50-50 shot. So more dovish on that stance. But then they actually get more hawkish in that they say the Fed will cut 75 basis points more by the end of the third quarter next year, and then that they're likely stop there, essentially arguing for a higher terminal rate than the average today, and being a bit more hawkish in that sense overall on monetary policy, which, if we're talking about that 12 months from now, the market may not be loving that. Now, if they're cooking in a bit more inflation assumption based upon the tariffs, and you blend that with Goldman's argument that the downside of policy is felt before the upside of other policies, then this makes sense, that the Fed will be looking to settle in and just take a break and watch in about 12 months. The Fed 12 months from now might see some inflationary pressures. They might see the economy otherwise doing rather well, and they might take a wait-and-see approach at that time. And that J.P. Morgan says that, quote, options differ on how literally to take Trump's campaign rhetoric on trade, end quote, going on to say that their baseline assumption will, quote, certainly be wrong. J.P. Morgan saying that they themselves are certainly going to be wrong, but nonetheless, they start off today by assuming that we're going to see 60% across-the-board tariff on Chinese goods. That's their baseline, that they're going to see a 60% tariff on all Chinese goods, but not a universal tariff on all other imports, and that this assumption, the Chinese part alone, is going to add about 0.2% by their calculation. They have people who can calculate that. I don't. But to take it what it's worth, 60% tariff on all Chinese goods, but not the additional tariff on other foreign goods, that leads just 0.2% to inflation next year. That seems a bit low, but what do I know? The Goldman piece goes further in that both reports agree on the basics, which is funny because one report is titled Two Paths and the other is New Policy, Similar Path. But to counterbalance what is expected, Goldman went further to what could go wrong for the markets. And while J.P. Morgan dismisses the universal tariffs, Goldman says it remains a risk and that, quote, Trump proposed a 10 to 20% universal tariff, which would be many times the size of just the China-focused tariff, end quote. And that it would take inflation, that if we had a 10%, the report says if there was a 10% universal tariff on all imports, it would itself take inflation in the U.S. to 3% from roughly 2.2 today, and could shave over 1% off of the GDP growth rate for next year. So that being said, I want to at least share some sort of example of what could go wrong, because of all this is also including statements regarding a higher level of uncertainty. And we here are going to be pivoting and reacting as more tangible actions start to really become actionable and knowable really in, 6 weeks or so. But for now, I'm going to roll into a quick break, and then I'm going to return and look at how these analysts got their market targets for next year, and then we'll get specific with a couple of stocks. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Democrats will help this sector, and Republicans that sector. Sounds simple, but the relationships between politics, policy, and market outcomes are much more nuanced. Every week, the Wise Investor Show discusses the latest financial trends and what investors need to know. Want to become a better informed, wise investor and navigate your investments through today's polarized political landscape? Listen at raymondjames.com/The Wise Investor Group, or find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. We're now finishing up third quarter earnings season, and according to Strategists, the earnings growth rate of about 9%, that this is the third quarter in a row that the earnings growth rate exceeded the consensus analyst estimates that were there at the start of the quarter. And on the show, we've pointed this out many times over the years, how it's typically the opposite, that throughout many strong markets that were doing quite well, that analysts were actually in the practice of ratcheting down their expectations through the quarter, ultimately creating this really low hurdle and one that was really easy for the results to leap over during earnings season. But for 2024, the earnings have actually continued to exceed the previous estimates. They've been ratcheting higher. And part of that is a more resilient underlying economy, better than many had feared. But today it's also starting to show a few signs that we might be borrowing from the future, that future earnings are being pulled forward to today. And strategists pointed to this as a reason growth has exceeded estimates. And in a Wall Street Journal article this week, they pointed out that, quote, exports from China surged last month, which some economists think could have been driven at least in part by front-loading amid uncertainty around election results, end quote. And this is what we saw during Trump's first term in office, and it's starting to show up again, where businesses, to the extent that they can, are loading up in inventories today before taking on the costs of tariffs for their goods in the near future. And if this continues and succeeds for a while, which it did in 2017, and the other assumptions I've talked about do play out without any other major wild cards, then the baseline, what we're working off today, is that Q4 is borrowing a bit from the first half of 2025, but 2025 is likely to start with continued overall momentum from this year, with earnings growth outpacing expectations until we start seeing the effects of tariffs dampening that growth a bit toward the end of the first quarter into the second quarter, which will be bringing on some rising inflation, some inflationary pressures, and then bringing on the debate on podcasts and whatnot about the path of monetary policy and the future expectations for rate cuts, at which point in the second half of next year, growth starts to see then a big boost, a tailwind from the effects of deregulation, lower taxes, and that translates to higher earnings growth, which will then give us that swing elsewhere. So that's what I meant by the mini cycles earlier. It itself is pretty clean as a story with just too many variables yet to be factored in, including what develops overseas and issues that we have failed to consider at this point. But using this amalgam of outlooks to form a baseline, it allows us to anticipate and not overreact. And by us, I mean we, you listening as well. Don't overreact to what the markets may do if it follows this path. To not get overly bullish if this year continues, the momentum continues, and the markets continue to rise into the beginning of 2025, and then not to panic if it gives a bit back. Maybe we'll see a proper correction, maybe, but as first quarter, maybe into the second quarter, as the negative aspects start to show their faces later on and be priced in, and the market starts to maybe get a little squirrely. As I mentioned earlier, Goldman themselves predicted a 10-year average return on the S&P 500 of 3% per year. And this past week, that same department over there issued a generally upbeat forecast for 2025 with a year-end target of 6,500 for the S&P, which is about 10% higher than it is today. And if they expect a 10-year average of 3% and the first year of that decade is going to be 10%, then the subsequent years mathematically have to be pretty ugly. Still, the consensus estimate for the S&P 500 earnings for 2026 right now is $308. And if you trade the index, let's say a year from now it's trading at 20 times that next year's earnings estimate, that would get you 6,160, which is roughly 4% higher than the index is trading today. Although, maybe we keep up this streak we've had here for 3 quarters now of the market beating earnings estimates forecasts, and that $308 estimate proves to be too low. It almost would have to be for this to end well. All right, let's take a look at a couple of stocks before I bail for Thanksgiving here. First off, an update on a stock that many hate to love. Love to hate is the cliche, but today Disney, DIS, is the stock we hate to love. But it became a little bit easier to like it this past week, I guess. And with that, let me add our caveat here that while I say many hate to love it, and love is a bit hyperbolic, I do own shares in Disney, and we own it for our clients. So while it's been a struggle at times through recent memory, this year has wound up to be pretty good for it so far. Nonetheless, I'm conflicted here. I have a conflict of interest and a bias towards it going higher. Nonetheless, this past week, Disney announced their fiscal fourth quarter results and proved once again that basically it's all about what happens in their streaming business that the street cares about. And this quarter alluded to the notion that they may have now crossed the tipping point whereby the years of investment, plowing money into this thing, has resulted now in growing positive free cash flow from that streaming business. The actual quarterly per share numbers were unremarkable. They had earnings of $1.14 a share, and the FactSet estimate was for $1.11 a share. But the shares jumped over 10% on the news that day. Actually continued a bit higher now, almost a week later, largely based on the news that streaming is now profitable, as they also had some solid box office results for some big releases. And they actually still saw some softness in the parks, but the street looked right past that. The consensus per FactSet for that streaming division alone was for it to earn $131 million for the quarter. But it turned into instead a profit of $253 million for the quarter. And this paired well with a slide I saw from a report from folks over at Owl & Company. I had one little bit of a larger slide deck, I guess. But that piece said that this quarter was, in their language, an inflection point for overall streaming businesses. And on it, they showed that all the majors, except for Paramount, were turning a profit for the quarter on streaming, and revenues from a combination of streaming fees and ads and other sources were, in most cases, growing by over 10%, and were up 15% year over year for Disney alone. And on the results for the quarter, Bob Iger, Disney's CEO for now, said they've turned the corner, and now they expect to continuously ramp up free cash flow growth after years of investment, as well as existential challenges to various elements of the business. The company guided that they expect streaming to earn $875 million from streaming in 2025, which is still a small portion of total earnings, which are projected to be over $16 billion, according to FactSet. But it's the portion of the business that is now hopefully convincingly growing the fastest and may prove to ultimately have the highest margins. One interesting tidbit was that Nelson Peltz is the managing director of Tryon. Well, Tryon at least disclosed just before this earnings report came out, Tryon announced that they have fully liquidated what was left of their large position in Disney. Now, Peltz, and I mention this because Peltz was this infamous foe of Bob Iger, and somewhat narrowly, I guess, lost a proxy fight that brewed for quite a while, challenging for board seats, challenging for what Disney's future was. And Bob Iger won and maybe has now proven Nelson wrong. It looks like Iger may be in the right track. And unfortunately for Mr. Pelt, he bailed on the stock more than 10% lower than it is today. Still, it was just one quarter. In their response to it, analysts over at Piper Sandler, who ranks the stock as a neutral right now, points to the results exceeding their expectations, but says they, quote, prefer to observe another quarter of execution before turning more bullish, end quote, which if they at Disney can keep it up, maybe that leads to a period where these types of analysts and firms out there start jumping on the bandwagon with bullish reports and upgrades, which would further obviously build a tailwind potentially for the stock as the street gets more and more bullish. Analysts over at Needham pointed out in their response to the quarter that a, quote, crossover, end quote, has occurred where the growth in streaming earnings more than now offsets the decline in traditional linear TV offerings. Moving on, before I call it a day here, I want to give a very brief update that I think is really meaningful, though, on Merck. And Simon discussed what's happening at Merck last week. But since that podcast, this is a kind of significant update, I guess. This is another one which I own personally and we own for our clients. And it's been, unfortunately, on a steady decline for much of this year. It's trading negative 9% for the year right now. But this past week, the company released an update on their cornerstone drug, Keytruda. That's a drug that has been successful in improving the outcomes as a treatment for many forms of cancer now. And recently, stock has been under some pressure. Along with its peers, there's been some pressure because of they make some money selling vaccines, and the vaccine makers haven't been doing well. They also sell, or had hoped to sell, a lot of Gardasil, a vaccine, in China, and there's been some false starts there. But the big one is still Keytruda, which makes up about 50% of Merck's total sales right now. And Keytruda only has patent protection through 2028, which really is around the corner. And they really need to get new therapeutics out there to replace that revenue, as well as making efforts and strides to protect and extend that patent for Keytruda, which apparently they've had some success at with the results this past week. This past week, Merck announced that an injectable version of Keytruda, which is finishing up its phase 3 trials, had similar results to the traditional infusion form of the drug, and that the way Keytruda is given to patients now, it requires a quick visit to a hospital or a clinic. It requires the patient to be there for a few hours. Per an article last week in Barron's, Merck would now receive new patent coverage on this approach, and they quoted the CEO of Merck saying that about half of the Keytruda sales would be expected to be moving to this method by 2028. And Goldman Sachs, who also ranks Merck a buy, they have a $135 price target on Merck, says that this version of Keytruda would be offered patent protection through 2038. So basically, they've gotten themselves another decade by switching to an injectable form. Okay, that's it for me this week, folks. I appreciate you tuning in. It may be pretty close to the Thanksgiving holiday by the time you hit play on this. So have a wonderful holiday with friends and family. Don't be afraid or shy to share this with them. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.